battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. You'll remember, for the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back to the show, episode 152, the stealth correction. I do believe we have seen a stealth correction. We'll get into that in just 1 second. A couple of quick announcements. Oh, and by the way, before we do the announcements, just a reminder, subscribe to the show. It helps us get it to more and more people. Click the subscribe button. You may be watching on Apple. You may be watching on Spotify or even Apple. And you're going to want to hit subscribe. You're going to want to share it with your friends and family so they can get the clarity and confidence, the good news, so they don't panic off their plan. Okay, now let's talk announcements. I mentioned this a few weeks ago. It was so good. You got to go watch it. Marta Norton, the former CIO of Morningstar, actually just made a career change. Congrats, Marta, on the move. But phenomenal episode and show. Did that with Sam Hardy here in the studio. Go watch it. Give you some good insights into where Stenger Family Office is looking for opportunity for our clients, what Morningstar does, and how we use them in the portfolio. And there's been a tremendous deck of speakers. You got to go watch Bullish. I mean, Bullish, in my opinion, I'm biased, but it gets better and better each episode. We've had some phenomenal guests. Dave McGarrell at First Trust. We've had Jeremy Schwartz from Wisdom Tree. Marta Norton. We've got some phenomenal guests. I can't announce them quite yet, but we've got some really good ones coming to you later this month and next month. So stay close to Bullish. Stay close to this show. And also get 2025 Investor Day on the calendar, coming to you very soon, November 7th and 8th, this year, 2024. We call it 2025 because we're always forward-looking. We're trying to tell you what's coming, not what's happening right now, tomorrow's news today. That's why we call it 2025 Investor Day, happening November 7th and 8th, downtown Naperville, Hotel Indigo, featuring the legendary, and I don't mean that lightly, the legendary Dr. Ed Yardeni of Yardeni Research, the most bullish guy on Wall Street. Maybe not the most bullish, I don't know for sure, but he's up there. He's got to be in the top 2 or 3 for sure. We've said the S&P is fairly valued, probably will go a little bit higher here. Ed Yardeni, Dr. Ed has said, hey, we think stocks are dramatically undervalued. We think stocks are going to go a lot higher. Now, I think Dr. Ed's going to be right in the long term. I do think he's going to nail the call, maybe a year after or 2 years after what we think, but that's okay. You got to come see him. November 7th and 8th, downtown Naperville, 2025 Investor Day. Wanted to make one mention of today, which is June 6th, 2024, happens to be the 80th anniversary of D-Day, when the Allied forces stormed the beaches of Normandy. Thank you to all of you who served. Thank you to all of you who served in World War II, like my grandparents did. And I believe there's one person still alive from D-Day, actually. One gentleman, I believe he's 103 years old, and they just did a beautiful article on him. I think it was an ESPN that just came out this morning. Go check that out. And it reminded me of a quote from Ronald Reagan I want to share with you. Since we're in a political election year, freedom is never more than one generation away from extinction. We didn't pass it to our children in the bloodstream. It must be fought for, protected, handed on for them to do the same. Or one day we will spend our sunset years telling our children and our children's children what it was once like in the United States, where men were free. That's a stark warning to all of us. We all need to remember that freedom is only as good as the current generation's protection of it. And I've been thinking a little bit about this, giving it some thought. And I do think the reality of freedom and how do you really guard freedom comes down to power itself. And there's another great quote out there, absolute power corrupts and absolute power, or power corrupts and absolute power corrupts absolutely. That is really the danger of a big government. And so, yes, we see tyranny come from all sides of the political aisle. We've seen it come from the left. We've seen it come from the right. What it all does is it concentrates power at the top of the food chain and gives maybe a handful of people, maybe even 100 people, a select group of elites, power over the masses. And that's dangerous. When the government gets too big in size, we can lose our freedom very quickly. And so we need to guard against that. We need to be paying attention to how big the government's getting. And this is not a statement about left or right. It's not about Republican or Democrat. It's about small government. It's about the individual, letting entrepreneurs flourish and thrive. so that we can be free long term. Why do the tyrants, why do the communist governments, why do they hate Twitter? Why do they hate social media being truly free where people can express themselves? Why do they hate the freedom of speech? Because they know that a lot of things in life come down to your thoughts, your thinking, words. Words have meaning. 1984, George Orwell. And the fact of the matter is every tyrant, every government tries to shut down free speech because they know that's the avenue, that's the pipelines to freedom. And so one of the things that China does is they block the internet. They block people from accessing information. The current technology we have, and I would say Twitter is one of the best. It's got its problems. I understand that there's goofy stuff on there. It's got its issues. Nothing's perfect. But one of the best things about Twitter is the fact that you can get real-time information. It's very hard to censor that information. It's very hard to suppress the truth. And that's what we need more of. We need more freedom so that our lives can get better and better over time. I'll make one comment on the political environment here. And I just want to give you the 10,000-foot overview, the bird's eye view of what's really going on, so that you don't get distracted by the day-to-day politics. You got to be very careful of this, that you don't start hating your neighbor. You don't start hating the other side of the political aisle. If you're a Democrat, be careful. The Republicans, like I've said in the past, are not your enemy. The Republicans, if you hate Democrats, the Democrats are not your enemy. Be very, very careful with this. The politicians are run by somebody much, much bigger, a much bigger idea, which is really centralized banking. And I know this sounds crazy, but I just want to explain this for a second. The banks, the centralized banking system runs politicians. Politicians are puppets, both sides of the aisle, left or right, of a much higher power, which is really people who want to not only consolidate power within the United States, but on a global scale. And that's what we've watched during the past couple of years, the Great Reset. We've watched the UN and Klaus Schwab and all the scary tactics that they've put out, that you're going to own nothing, you're going to like it, that, you know, you can't own a cow because it farts too much. You can't plug your toaster in because it's all about climate change for some reason. But, you know, all these people can fly to Davos in their private jets and produce all these crazy emissions. You bet your bottom dollar they can plug their toaster in. They can eat meat. They can do all this stuff. You can't. That should give you a little bit of a pause, be a little bit scary when you hear about these 15-minute cities. You hear about, you know, nothing and like it, going to be a renting economy forever. That is not a good environment for prosperity. We want to have less and less power concentrated in a few hands. We want to have the individual flourish. And that's what the 80th anniversary of D-Day brings to mind for me, and I think for many of our clients as well. So enough on that. Let's get into this week's content and article. Something really interesting in the news that's happened is this new president that got elected in Mexico, Claudia Sheinbaum. I'm not sure if I'm saying that correctly. Claudia won in a landslide. Here's what's crazy. Mexico had 30 political candidates this cycle that were assassinated, killed. Think about that. That's crazy. That's like 30% of the U.S. Senate just goes missing in one election cycle. So you're like, Nick, oh, Twitter's so bad. The tweets are so mean. DC is crazy. They're fighting with each other. It's so dysfunctional. Well, hold on one second. It's not as bad as it could be. 30 people in Mexico killed, assassinated during the election. That's a little bit scary. Claudia is a socialist. The socialists are celebrating her victory. And she does have deep Chinese ties, surprise, surprise, just like the Prime Minister of Canada has and a lot of other places. Here's what's really interesting, and this is where markets are just phenomenal. Markets, remember, are sort of a discounting mechanism. They price things in advance. They panic when things, you know, before bad news is going to happen, and then they rally before good news comes out. Mexico's stocks went down 18% when Claudia was elected. So we'll see if her socialist policies hold up. We'll see if the tactics that she uses, the economic policies that she passes in Mexico are good. But the stock market's saying, hey, wait a second, we don't love socialism. Mexico stocks went down 18%. That's in stark contrast to Javier Milei in Argentina, who rallied on the fact, and he was a populist, but he rallied on the fact that we're going to cut the size of government. So we're going to have smaller government. We're going to get rid of all these massive spending bills. We're going to fix the debt crisis in Argentina, and with it, we're going to fix inflation. Argentina inflation is insane. There's literally videos you can look up of people showing up to pay for food with briefcases of currency because there's literally 20, 30% inflation, sometimes on a month-to-month basis, which is insane. Here's what Argentina stocks did when Javier Milei, who ran on smaller government, was elected in Argentina. Stocks went up 26%. So if you don't believe that smaller government leads to better outcomes for the equity markets, you are badly mistaken. There is a direct impact from policy on the economy and on company earnings. Now, you may say, Nick, sounds kind of contradictory. You've been bullish on the U.S. You've been bullish on the U.S. economy. If you think government is going to get bigger in November, potentially, are you concerned about the U.S. stock market? Everybody's saying, Nick, I'm very concerned about November. Are my stocks going to be at risk? Is my portfolio going to go down if we don't get some gridlock and common sense in D.C.? And my answer is just wait. I don't think it's going to, I could be wrong. I could be wrong about everything, right? But I'll just tell you, and I think we've been right more than we've been wrong. I think we've been right consistently throughout multiple election cycles now. The U.S. always does the right thing after trying everything else first. That's I believe, a Churchill quote. I do think we're going to get divided government in November. So that's an early prediction, an early call. Now, let's just say we don't get common sense in D.C. Let's just say we don't get smaller government and we don't get at least a divide where there's gridlock and not a whole lot of anything happens. Well, then I would just be in high quality. I told you this last week in the jungle. You take your machete out, you chop down the trees in front of you, you get through the garbage and you get to the high quality, the good stocks. I think all the high quality best stocks are in the United States. And I've been avoiding mid caps. I've been avoiding small caps for clients. We've been avoiding China. We've been avoiding Europe and Japan. Not that these are bad places or there's bad people there, but all the best people from those places are here. And the U.S. provides them the rule of law and personal property rights. And it so happens that the top companies, the top tier names in the S&P are truly great companies. And this is not investment advice, but you're asking yourself, Nick, why is NVIDIA up like 1,000%? Why is Tesla 1,000% the past 5 years? Well, because it's, their earnings and these are real companies now. There are some Fugazi-ish companies like you had in the 90s with the tech bubble and the tech crisis. When it popped, Cisco still has never returned to the levels it was at, even 24, 25 years ago now. But a lot of companies today are much different than the late 90s. They're actually trading at pretty darn reasonable levels. Now, NVIDIA is going to trade at a 44 forward price to earnings ratio. A lot of other companies that are high tech, high growth are going to trade 30, 40, 50 times. There will come a time where that becomes unsustainable. And certainly when you pass the 100 mark on forward earnings, it gets very tough to make money on a stock where you're trading at triple digit P ratios. But what you have to be careful about is that you don't end up in a value trap either. This is where value investors have really gone wrong the past 5 to 10 years is they've looked at value-oriented companies, meaning companies that are trading down off their all-time highs that are maybe at a 5 or 6 or 7 price to earnings ratio. Remember, NVIDIA's at 44. So if NVIDIA makes $1 million in profit, for example, just easy example, they make way more than that, but let's just say it's $1 million in profit. Every $1 million in profit's worth $44 million in market cap. Well, think about a company that's more of a value stock, might trade at 7 or 8 times. You think, hey, 44 is a lot higher than 7 or 8. I'll buy the one for 7 or 8. That's not really how stocks and companies and investments work. You have to look at future growth rates. Sometimes stuff is cheap for a reason. And if a company's been trading at 5 to 10 times earnings or even 12 or 13, and there's really no growth, you could get into a value trap, a company where you really don't want to own it. You're not going to make money for the long run. And sometimes what happens with value is it's a trade. And so what we do in our portfolio is give you a little inside baseball. We've studied this very diligently, especially the past 3 to 5 years, is we've said, okay, the ideal mix between growth and value seems to be about 60 to 65% growth and about 35 to 40% value. That tends to work pretty well because value does insulate you sometimes during some of these higher inflation environments. And you've seen since inflation has gone up the past 2-3 years now, rates have gone up. Value actually has outperformed during the entire cycle. Is that a trade? Is it a lasting thing that's going to stay for the next 5 years? I don't think it's going to last the next 5 years. I think growth is going to take the lead. But if you've owned value in the portfolio, if you own dividend growth stocks, companies that really have strong cash flows like energy stocks and financials and all the rest of it, even utilities now are coming back in a big way this year. You've been protected through the entire cycle. Whereas if you bought growth at the all-time highs, the classic example, not knocking her at all, not saying this is, hey, I'm not talking bad about this person, but Kathy Woods, she's from ARK Innovation Fund and did really, really well with 0% rates. Well, when rates went up, her fund got clobbered and she was paying 40, 50, 100, 150 times earnings for some of these stocks she was buying. And that fund is still not even close to its all-time highs. Most people, I think the stat was like 85 or 90% of the people in that ETF now are actually underwater. And that's where you have to be diversified. You do have to have a little bit of value in the portfolio, but if you overdo it, that's where you can give up long-term growth. So anyways, let's get into the stealth correction. The S&P 500 index is up around 11% year to date. Comparatively, mid caps are only up 8%. Listen to this. Small caps, now I wrote this a couple days ago, but small caps are up just under 2% year to date. Large caps up 11, mid caps up 8, small caps up just under 2. Growth-oriented companies have led the charge in 2024, coming off a strong 2023, and remember, a bloodbath in 2022. And so you may be thinking to yourself, why are the Magnificent Seven doing so well in 2024? Why are they doing so well in 2023 last year? Well, because they had a terrible year in 2022. Now, think about the past few years, though, as a cycle. In 2019, you had a melt your face off, unbelievable year, just insane. You did so well in 2019 if you just stayed on your plan and bought the biggest and best. 2020, despite COVID, despite being down 35% in March, the year ended up 20% for large cap companies. So you went up a bunch in 2019, you went up a bunch in 2020, and then right when you thought it couldn't be any better, 2021 was a rip your face off year again. Unbelievable. You did probably triple or even quadruple what your plan called for. So then you got to 2022 and you handed a little bit back. Now, if you had been investing in 2019, 2020, and you gave some back in 2022 and you just stayed on the plan, you didn't panic, you didn't freak out, by 2023, you were right back to where you started. You made a ton of money in 2023 last year, and then you stayed the course this year. 2024, you're up double digits again. Unbelievable. However, if you started your investment journey at the peak of 2022, right off the bat, you lost 22%. That's a big correction, tough to recover from, but you stayed on your course. You listened to what we told you to do. You're still working your plan. 2023, you came right back. 2024, you're coming back again. And again, if you look at the beginning of 2019 to today, to 2024, growth stocks have certainly outperformed. However, if you're looking at 2022 till today, value stocks have actually outperformed growth. And that's, again, why you have to have that mix. So why do you see this difference between growth and value? Why is it that Microsoft, Amazon, Meta, Google, and NVIDIA, since the peak of 2022 with the crash, are only up 5%, while dividend-oriented value stocks are up 23%? Well, because interest rates influence, not profitability necessarily if you're a really good company. Yes, it can, right? Rising interest costs can be a problem. But think about Apple for a second, sitting on something like $160, $170 billion in cash now on their balance sheet. Apple is actually benefiting from higher interest rates. They're getting higher net interest today than they would have a few years ago. So these bigger companies, yes, maybe in the short term, they get hurt on their earnings, but in the long run, if you have a good balance sheet, you're well managed, you're not taking out a lot of debt like a small cap or mid cap. That's why, by the way, they've underperformed, in my opinion. You're doing fine on your large caps. But in the short term, valuations can reset based on what the Fed is doing. So think about a 0% interest rate. If you were growing 5% and rates were 0, and you weren't taking on tons of risk as a company, you were maybe hiring a few people, you were maybe doing some capital expenditures, maybe building a new plant or factory, or if you're a restaurant, putting up a new restaurant every couple of months or something, you were doing fine because cost of capital was nothing. You could borrow for basically nothing. Money was free, and then you could go grow at 5. Well, the problem now is when interest rates go up to 5%, and then there's a spread on top of that because banks got to get paid for taking risk and making loans. they're going to put a 5% spread on top of that 5% risk-free treasury rate. Now you're borrowed at 10%. So think about it logically. If you can only grow 5, you're borrowing at 10. What are you going to do as a company? You're going to be like, wait a second, let's slow down here. Let's not do anything crazy. Let's not expand too fast. We're going to talk about potential recession on every earnings call. We're going to set the stage for, hey, we might not do as well this year. And what companies are you seeing that in particular finally? Now it's coming to consumer discretionary. So remember during COVID, what did well? Solo Stove, Traeger, Peloton. People are, they're smoking their meats, they're having a bonfire, and then they're eating too many smoked meats, so they got to ride their Peloton and work it off. And now their Peloton they might be using the Solo Stove still, probably still using the Traeger to some degree. They're not buying a new one. They're just using that old one, letting it collect dust. Or more often than not, it's the Peloton that's now a clothes rack in their basement, like mine is. And you're not Pelotoning every day, so you're not buying any new Pelotons. Peloton's seeing a huge drop off in membership and subscribers. So it's a lot of these stocks where, hey, if you didn't run your company that well and you didn't fortify your balance sheet, you didn't build up cash, and you were taking a ton of debt out in 2020 and 2021 to fuel your expansion, well, guess what? You were on a 5-year revolver in a lot of cases that's now coming due in 2024, or will come due next year in 2025, or if you started in 21, is going to come due in 2026 in 2 years. And you're thinking, hey, we gotta cross our fingers and hope that the Fed cuts interest rates. And the Fed's like, no way, we're not cutting interest rates. We're not giving the market any positive surprises. And I think that's actually the wrong move on the Fed's part. I think they should be cutting. I think they could cut to 3.5, and that would still be a fair interest rate. You're seeing this in the ECB, the European Central Bank has cut. They're cutting interest rates, and maybe it's political. I don't know. Nobody knows for sure, but I do think the Fed will cut. I think part of the rally here is because people think the Fed's going to cut. But if you look at the expectations of where cuts are coming in, we thought we were going to get, now, not we meaning Stenger Family Office, but Wall Street thought we were going to get cuts already in March this year. Well, now those predictions are fast forwarding to next year, maybe even next fall. I think there's a good chance the Fed stays higher than people think, a little bit longer than they think. Now, do rates go up? Maybe. Jamie Dimon says they could go up to 6%. It's possible. I don't think it's out of the ordinary that could happen. But I think Powell's going to be more like an Arthur Burns. I think he wants to be a little bit softer on inflation and risk inflation coming back. Because, by the way, he's been Fed chair for a while now. He's going to retire eventually. He's going to get out of that job. Somebody else will get appointed. And then it's really not, it's like, wipe my hands. It's not my problem anymore. That's probably what he's going to do. He wants to go down loved in the history books. Like Michael Scott once said in The Office, would you rather be loved or hated? He said, I want people to be afraid of how much they love me. That's basically Powell. So anyways, let's talk real quickly the rest of the article here. So I just want to mention one other thing about these large caps, the Magnificent Seven. Stocks can go up when rates go down, even if profits stagnate. So you could see your stock prices fluctuate just because rates are fluctuating. Profits are going to still be strong. And that's what you really want to watch. So if you're paying the right price for earnings and you're not overpaying and rates are high and there's bad sentiment in the market and people are panicking a little bit, don't panic out of your stock. Just watch profits. If profits are doing okay and the company's managed well, you'll be fine. And so that's why you just stay on the course. But the signal of stock prices is profits. So as profits rise, as profits grow, that's the true value of owning a company. The noise is the Federal Reserve. The noise of the Federal Reserve will pass. It will be over before you know it. Here's what's really interesting. NVIDIA today is now worth a little over $3 trillion. It's more than 50% more valuable than Amazon. It's 5 times more valuable than JP Morgan. It's a shocking 5.5 times more valuable than ExxonMobil, even after returning more than 3,000% for investors the past 5 years. So where does this all go wrong for NVIDIA? And this is kind of an interesting thing to think about. Number one, competition could kill growth and earnings could fall. It's a possibility. I think it's less likely than a second scenario, which is that growth eventually slows and investors place a different multiple on NVIDIA's future profits. And so if you start to see the valuation on NVIDIA fall from 44 to 30 or 25, that's where you get nervous. I'm just going to say, I don't think that's really going to happen overnight. I think if you look at comparative companies here, you look at Amazon through the 90s, they were never profitable. Amazon said, hey, we're going to reinvest all of our profits. We're not going to show a profit. Jeff Bezos was adamant about that. They made fun of him on the Tonight Show and said, well, you lost $5 billion this year. Ha ha. What's wrong with you, Jeff Bezos? And then secretly, he's now gotten the last laugh. So you could reinvest those profits. You could show less profitability to go into growth. So could you see the multiple drop in the short term? Sure. Maybe in a correction, there's some bad news, a black swan event happens, a geopolitical thing happens, something bad in the market comes up. Yeah, of course, the bigger they are, the harder they fall. But I don't see why we should drop the earnings multiple on NVIDIA as long as the growth is there. I mean, they're doubling their profits every couple of years. That could slow down, but it's still not going to slow down to the point where you can't put a decent multiple on it. And then what they'll do is they'll pivot like Apple did, I believe, at some point. Remember, Apple was very innovative under Steve Jobs. Steve Jobs was an innovator. Well, Tim Cook, the current CEO of Apple, really smart guy, really sharp guy, running the company extraordinarily well. Stock's done great for investors, but he's not an innovator. He's a operator. He's a good operator. And so while Apple has had little to no growth the past few years now, especially in iPhone sales, Apple's still been able to do well through financial engineering. They bought back their stock. They have paid dividends. They've increased those dividends. They've done a lot of things to boost earnings per share that way rather than growing the top line. Will that eventually become problematic for Apple? Yes, it will. And we're all over it. We're watching it. I'm not saying to sell Apple stock. I do think they're going to be a beneficiary of AI. I do think there's a lot of innovation that could come out of Apple. So we're going to hold it. It's a great company. But it's just a warning sign that companies go through these life cycles. They grow, and then they kind of adjust if they're smart, and they fortify their balance sheet, and they pay back a lot of their earnings to investors just in the back through the back door, which would be dividends and buybacks. Of the mega caps year to date, Tesla is down 30%. Salesforce is down 10%. Johnson & Johnson, United Health Group are down 6%. In the large cap bucket, Intel's down 40%. Walgreens is down 39%. Boeing's down 30%. Adobe's down 26%. Gilead's down 21%. And Humana is down 20%. And so my point to you is, despite NVIDIA having a really positive impact on S&P returns this year, there's still a lot of companies that are in a stealth recession. And that's a healthy thing for markets. It's not a bad thing. Still, obviously, the majority of S&P companies are actually up for the year. Large caps in particular, mega caps, certainly about 75-80% of them are up. That's great. That's market breadth. But it's a healthy thing to have this rotation, even through the Mag 7. And so the fact that Tesla's down while Amazon's up and Microsoft now has kind of leveled off a little bit while NVIDIA takes off, that's a really good thing. You want to see some of this broadening out across these companies. If you're seeing all these companies just go up every single day and nothing's correcting, nothing's going down, that's the sign that you're getting close to a 90s style tech boom and bust. We're just not in that today. There's nothing data-wise to suggest that the sky is going to fall tomorrow. I think eventually, if we don't have earnings growth catch up with price to earnings ratios, sure, we could have a massive correction. But you got to remember, if we're trading the S&P at 5,300 points, we're about a 20 forward price to earnings ratio. Well, guess what? The past 5 years has been pretty darn close to 20 times earnings, maybe a little bit lower, but I think we'll catch up with earnings growth again. And so if earnings continue to rise at that 6, 7, 8% pace, dividends go up 1.5%, 2%, 3% on top of that 6 or 7% earnings growth. Why couldn't we see $300, maybe $315 in earnings on the S&P, like Dr. Ed is saying, and multiply it by 20 and come up with 6,000 to 6,300 points for a fair value on the S&P. And that's exactly what I think is going to happen. I think the next couple years, you're going to see stocks continue to do fine. I think you're going to continue to see gains. You're going to see 8, 9, 10% gains the next few years. Now, I'm not willing to give you an estimate right this second, 2 years out, and say, hey, by the end of 2026, S&P 6,300. But I think there's a good chance it could happen. And maybe it takes 2 years, maybe it takes 3. But if you're on a long-term goals-based plan, who cares? Keep putting your money in the market. Next time there's a correction, which is going to happen at some time, at some point, we're going to have a downturn. throw more in. And like if the S&P, for example, gets down to 4,750 or 4,800, throw a couple hundred from your treasuries in. We'll do that for you automatically at Stenger Family Office. That's part of what you pay us for, is rebalancing. So that's what I would do, is just be aware of mentally the fact that we are going to have a correction at some point here. It's going to be a great buying opportunity, but earnings growth is still incredibly strong, and rates will come down. At some point, we are going to come back down the other side of the mountain, and you don't want to wait till that happens, because by the time it happens, it's already going to be too late. The market will have been up 20%, and you're going to be thinking, oh man, I should have just bought at 5,000 or 5,200 like Nick said. And I'm almost positive that this will be the correct advice. It may take us 18 months. It may take us 24 months. It might take us 3 years. But I think when you look back a few years from today, you're going to say, man, I'm really happy I stayed the course and put a little bit more to work. In the end, the same Stenger playbook, I believe, is going to work through both environments, where maybe inflation comes roaring back like it did in the 70s, or inflation really does come back down the other side of the mountain. And that's to do a few things. Number one, own quality companies. Number two, invest in U.S. entrepreneurs. Number three, hold large cap blue chips with real business models. Number four, avoid long-term bonds like the plague. And number five, never, 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 ever try to time the market. I think that if you stay on a rebalancing strategy, you're buying quality, you're sifting through, like we talked about last week, 8,300 companies, getting down to 100, or even like we do, 50 names that are the biggest and the best managed companies, best balance sheets, you're going to be okay through the entire cycle. You're obviously going to see corrections. You're obviously going to see downturns. But when it's all said and done, I think you're going to go on to see brand new all-time highs in your portfolio. So that's all I've got for you this week on episode 152. We'll see you next week again for episode 153.